The global wealth management industry allocates billions of dollars to build highly specific product pipelines, categorizing clients by a single metric, their birth year. This entire capital allocation strategy is built on generational cohort theory, a demographic model popularized by historians Neil Howe and William Strauss. The theory operates on a straightforward premise. It assumes that shared historical events during an age group's formative years imprint them with distinct permanent financial values and behaviors. Applied to modern finance, the industry assumes younger cohorts, millennials and Generation Z, demand digital-first tools, expect algorithmic trading, and strict environmental and social governance. Conversely, the industry assumes Generation X and baby boomers require traditional human advisors, relationship continuity, and analog reporting. Firms build their entire service delivery matrices around this diagonal line. A recent empirical study of the Indian market by researchers Srivatsan and Shiva Prasad set out to test this exact model. They analyzed 263 digitally engaged retail investors across the country. The resulting dataset indicates that within India's rapidly digitizing economy, the generational segmentation model collapses entirely. Firms using age to predict service expectations are directly misallocating their capital. To understand why the model breaks, we have to look at the strict parameters of the Srivatsan study. The 263 respondents in the dataset were distributed evenly across the four major cohorts: Gen Z, Millennials, Gen X, and Baby Boomers. The researchers tested these investors against four specific dimensions of wealth management. First, they measured their preference for digital platforms, followed by their prioritization of ESG investing. The final two dimensions measured their preference for direct advisory relationships and their expectations regarding fee transparency and financial education. Every participant rated their preferences using a structured 15-item Likert scale, ranging from a 1 for strongly disagree up to a 5 for strongly agree. Based on the Western predictive baseline, the resulting data should reveal severe variance. A millennial score on digital preference should look entirely different from a baby boomer score. If generational cohort theory is a universal law of financial behavior, this Indian dataset should immediately produce massive, statistically obvious divides between the age groups. The researchers ran the survey data through a one-way analysis of variance, or ANOVA, to test for these expected generational differences. This is the one-way ANOVA table. For statistical significance, the p-value must drop below 0.05. The actual values, 0.218, 0.575, 0.295, and 0.687 all fail the threshold, making differences indistinguishable from random noise. The eta-squared effect sizes show a maximum recorded value of just 0.017. Translated to financial operations, this means a client's generational cohort accounts for less than 1.7% of the total variance in what they expect. The mathematical reality is clear. Utilizing a client's age as a predictive metric to design or market financial products in India yields zero analytical value. We know there is no statistical divergence between the age groups, but looking closely at the mean scores reveals a counterintuitive pattern of convergence, particularly regarding digital adoption. This table maps preferences on a 1 to 5 scale. Looking at the digital preference row, millennials, assumed digital natives, scored 4.09. Surprisingly, baby boomers produced a score of 4.27. The oldest demographic reported the absolute highest digital preference of any cohort. This inversion occurs because of a structural mechanism. India experiences technological rollout through simultaneous diffusion, unlike the sequential diffusion seen in Western markets. In a sequential model, digital finance platforms enter the market and pass slowly from young early adopters down to older demographics over a 20-year span. India's adoption curve was a simultaneous shock. A single wave hit the entire population at once, forcing immediate adaptation regardless of age. Two macro infrastructure drivers forced this reality: the explosive nationwide rollout of the UPI payment network and mobile data priced at fractions of a cent. This infrastructure met a unique cultural catalyst during the 2020 pandemic lockdowns. Younger, tech-savvy family members directly onboarded their older relatives onto digital investment apps. Deep digital infrastructure, combined with intergenerational financial socialization, compressed the country's technology adoption curve into a few short years. Age no longer dictates digital readiness. This data also clarifies the advisory preference construct, dismantling a second major misconception in the wealth management sector. The industry operates on a strict binary. Firms believe they must choose between automated robo-advisors or retaining human relationship managers to serve older clients. Examining advisory expectations across the age spectrum contradicts this either-or approach. The youngest and oldest generations both demand exceedingly high levels of human advisory contact, reaching statistical near parity at 4.21 and 4.24. The older cohorts maintain high scores for expected reasons. Baby boomers seek human advisors to ensure trust-based relationship continuity and to manage complex estate planning. Gen Z seeks human advisors for a completely different purpose. They require informational guidance and expert validation at the onset of their investing journey. Young, digitally native retail investors operate in a vibrant but turbulent stock market. They recognize their inherent vulnerability to cognitive traps. Behavioral finance studies show these young investors require human intervention to mitigate severe biases, like overconfidence and loss aversion, specifically during periods of high market volatility. The psychological motivations are qualitatively different. Boomers want trust. Gen Z wants bias mitigation. But the ultimate functional demand they place on the wealth management firm is exactly the same. High digital fluency does not cannibalize the desire for human expertise. Investors view a sleek digital interface and a human advisor as mandatory complements. The macroeconomic implications of these convergence findings require an immediate reassessment by wealth management executives and product architects. Capital is currently isolated within separate demographic marketing silos, under the assumption that an investor's age defines their needs. The data dictates a strategic pivot. Firms must dissolve the barriers between these silos to reflect empirical reality. The required standard is a hybrid phygital service architecture. Seamless digital efficiency and embedded human advisory touchpoints are universal baseline requirements for all clients. Because ESG awareness is uniformly high across every cohort, it must become a core portfolio standard. It is a mainstream requirement, not a niche product category built solely for millennials. The expectation for proactive transparency is equally universal. Plain language fee disclosures and risk assessments must be readily accessible across all physical and digital interfaces. Financial institutions executing resource-heavy, bifurcated service tracks for different age brackets are burning capital on an empirically false premise. In the modern Indian wealth management sector, age is no longer a valid proxy for technological fluency or financial preference. Universal convergence demands universal architecture.